the top rates on money market funds, CDs, and annuities right now. Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to our weekly update. So, it was another interesting week in our country in light of this week's government shutdown. For one, the monthly jobs report that should have been released by the Bureau of Labor Statistics on Friday was not released, meaning our markets were left without their usual beginning of the month guidance on where things in the economy may be headed. More on this shortly, because first, I want to cover one of the top questions that you've sent our way since the Fed's recent rate cut decision. Here are the three topics that we'll be covering today. 1. What are the top rates currently on the money market funds, CDs, and annuities that many of you hold in your portfolio? Good rates are out there, even at the medium to longer maturities. For example, at the current time, it is still possible to get an above 5% multi-year guaranteed annuity with a AA+ rated firm, depending on your investment amount and state of residence. And we will cover that in this section later on. 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the predicted yields for the upcoming week's treasury auctions? And leave a comment for us and our channel regulars before we kick things off for today. How long do you think this government shutdown will last? Keeping in mind that on average, the 8 shutdowns over the past 4 decades lasted about 10.4 days, with the longest shutdown in 2018-2019 lasting 34 days. Let's dive in now, folks. What are the top rates currently on the money market funds, CDs, and annuities that many of you hold in your portfolio? Let's start this section with the top rates on some popular money market funds within our community. And let's go in alphabetical order with the 3 leading brokerage firms that we cover the most on our channel, beginning with Fidelity, then Schwab, and last but not least, Vanguard. For Fidelity Money Market Fund comparison, we have SPACs, FZFXX, FDRXX, and FDLXX, as well as FZDXX, which has a $100,000 minimum investment requirement. And because it seems that some of you have a fair bit of dry powder parked in money market funds currently, we've also included FMPXX, which has a $1 million minimum investment requirement. Do note that the first 4 on this list are government and Treasury money market funds, and the last 2 are prime money market funds. Government and Treasury money market funds are most comparable to T-bills in terms of risk-return profile, in that they invest mostly in Treasuries and other U.S. government debt securities, such as agencies. Prime money market funds, on the other hand, while still considered safe relative to other asset classes, tend to have a slightly higher risk-return profile than their government and Treasury counterparts. In other words, prime money market funds will generally have a bit of a higher yield relative to government and Treasury money market funds because they do not just hold government and Treasury securities in their portfolio. They may also hold highly rated securities from domestic and foreign corporations as well as financial institutions. So, in this column, we have the name of the fund. And in this column, we have the 7-day SEC yield at the time of this taping. Remember that the 7-day SEC yield is based on the last 7 days' performance of a money market fund, hence the name. But this is then converted into an annualized rate net of expenses, but before taxes. So the 7-day SEC yield should give you a good indication of how a money market fund investment has been performing for you on an annualized basis after cost. The 7-day SEC yield for these Fidelity government and Treasury money market funds is more or less in the same range, with SPACs at 3.8%, FZFXX at 3.76%, FDRXX at 3.85%, and FDLXX at 3.73%. FDRXX does have the highest yield, though, which may be driven by the fact that FDRXX's expense ratio can be as much as 5 basis points lower than that of SPACs, FZFXX, and FDLXX. FZDXX and FMPXX have generally higher yields at 3.97% and 4.09% respectively, which is primarily driven by their even lower expense ratios and the fact that they are prime money market funds that also hold higher yielding non-government and non-treasury securities in their portfolio, as we mentioned earlier. Also, keep in mind that because these money market funds do invest a part of their portfolio in U.S. government securities, some of the interest they earn on their investments may be exempt from state and local income taxes, as U.S. Treasuries generally are, which means that some of the dividends paid out to you from these funds may also be exempt from state and local income taxes when held in a taxable brokerage account, and depending on your state of residence. For example, if you had held FDLXX in your taxable brokerage account, about 97% of the total ordinary dividends may have been exempt from state and local taxes in 2024. In 2023, that percentage was a bit lower at 90%. If you want more details on this, please refer back to this money market fund video from earlier this year, link below in the first pinned comment. So that was Fidelity. Here's our Schwab money market fund comparison. SWVXX is Schwab's prime money market fund with a 7-day SEC yield of 3.98%. Up next, we have Schwab's 3 government and treasury money market funds with SNVXX at a 7-day SEC yield of 3.87%, SNOXX at 3.83%, and SNSXX at 3.78%. All 4 of these here are noted as investor shares. Schwab's money market funds have 2 share classes. The investor money market fund shares have a $0 minimum initial investment versus the equivalent ultra money market fund shares, which have a $1 million initial investment. The ultra money market fund shares also have lower expense ratios, which typically translate into 7-day SEC yield that is about 15 basis points more than their investor share equivalent. So that was Schwab. Now, let's move on to our Vanguard money market fund comparison of VMFXX, VMRXX, and VUSXX. All 3 of these are government and treasury money market funds, as Vanguard does not offer any prime money market funds. VMRXX and VUSXX have a minimum initial investment requirement of $3,000, while VMFXX does not, as it is Vanguard's core settlement fund. The 7-day SEC yields for all 3 of these funds is relatively similar at 4.06% and 4.07%, as you can see here, and at the time of this taping, higher than the yields on all 5 of these Fidelity money market funds here. The only exception is Fidelity's FMPXX, which has a marginally higher rate at 4.09%. But again, FMPXX is a prime money market fund, and there is a $1 million minimum. The 7-day SEC yields on these 3 Vanguard money market funds are also higher than practically all of Schwab's money market funds here, with the one exception again being SNAXX, which has a somewhat higher rate at 4.13%. But again, SNAXX is a prime money market fund and also has a $1 million minimum. And as the Vanguard fans in our community know, the main reason for these higher yields on Vanguard's money market funds is because of their generally lower expense ratios. And because I know some of you will ask, no, you cannot buy these Vanguard money market funds via Fidelity or Schwab. You can buy them via E-Trade though. So that's where rates stand for short-term cash that you want to keep liquid, with the 4% plus rates on Vanguard's money market funds still looking quite attractive. But here's the thing. These rates will go down when the Fed cuts rates again. You can't lock in rates with a money market fund. And at the current time, according to the CME Fed Watch tool, the market sees a more than 96% probability of another 25 basis point rate cut at the next FOMC meeting on October 29th to a Fed funds rate range of between 3.75% and 4%. Of course, a lot can change between now and then. And let's see how much data the Fed will actually have to work with if the shutdown drags on longer than expected. Who knows, right? That said, even if the Fed does not lower rates at the upcoming meeting, at some point, short-term rates will come down further, assuming inflation does not run rampant again. And when that happens, all the short-term money market fund rates that you see here will also come down. I know that some of our Diamond NestEgg regulars are taking a wait-and-see approach and continue to park their cash in money market funds, short-term bond funds, and T-bills that auto-roll, just like we are. But I also know that some of you want to lock in some of the current rates for a bit longer. After all, no one knows which direction medium and longer-term rates are headed, as those are more influenced by market forces. And that's why we did these two CD videos last week. Link below in the first pinned comment for those of you who might still be interested in something that will mature in about 2 years. Eagle Bank's 24-month CD has held steady at 4%, and so has American Express's 22-month CD at 4%. And for those of you who were disappointed that you missed this $1,000 new customer bonus from REGULATORs, do note that some of the folks in our community did email us to let us know that REGULATORs has extended this up to $1,000 new customer bonus until November 30th. So good luck if you want to take another shot at this. Now, for those of you who want to lock in the current rates for even longer, and as I promised at the beginning of this video, let's have a look at what multi-year guaranteed annuities, MYGAs, are yielding right now. As a refresher, a MYGA is a type of fixed annuity that is offered by insurance companies. The industry defines a MYGA as a fixed deferred annuity, and it works in 3 steps. First, you pay a lump sum premium to the insurance company at the beginning of the contract. Second, the amount you pay into the annuity earns a guaranteed fixed interest rate for the specific term of the contract, typically ranging from 2 to 10 years. That's where the fixed part of the name comes from. In addition, a MYGA usually comes with principal protection against market fluctuations. And third, at the end of the annuity contract or term, but not before, that's why it's called a deferred annuity, you get paid out the principal plus interest. At this point, you can either withdraw the full amount in cash, renew the contract, or convert it into another annuity product, such as a single premium immediate annuity, or SPIA, if you want to convert it into a lifetime income. Here are some sample rates for multi-year guaranteed annuities, MYGAs, from a AA+ rated insurance company that we work with. Here you have the investment amount, and for each investment range, here's the rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. So for example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this carrier, your rate might be 4.75%. A $50,000 7-year MYGA might earn you 4.85%, and a $100,000 MYGA might earn you even 5% for 7 years, as I mentioned towards the beginning of this video. And for those of you parking your cash in Fidelity's FMPXX or one of these Schwab Money Market Ultra shares with their $1 million minimums, the rate that you might be getting on a $1 million plus investment in a 7-year MYGA may be even higher than this 5% here. Do keep in mind that there are other factors that influence the rates that you may get on your MYGA, such as the credit rating of your insurer, your state of residence, and so on. And of course, MYGAs are not for everyone, and not least because they're not very liquid and come with significant early withdrawal penalties. As a reminder, you may want to consider a MYGA if you check one or more of these boxes. You're nearing retirement and want to convert the lump sum payout from a MYGA into a lifetime income stream at maturity. If you're pre-retiree considering annuitization, as the industry would say, you may be able to do this conversion tax-free. The reason is that MYGAs may often be exchanged tax-free into other annuities, like single premium immediate annuities, or SPIAs, via 1035 exchange. And if that's an option that sounds potentially attractive to you, and you want to learn more about how SPIAs may provide you with a lifelong income to supplement Social Security and other sources, you can find the link to this bond ladder versus SPIA video in the first pinned comment below this video. You may also want to consider a MYGA if you're a conservative investor with a low risk tolerance and seeking safe fixed returns without market exposure, as a MYGA offers principal protection and predictable growth over its lifetime. You're a tax-conscious investor. For example, you're in a higher tax bracket now, and you might be able to benefit from tax-deferred growth if you can delay withdrawals until you're in a lower tax bracket. You're a long-term saver with at least a 2-year investment horizon who doesn't need immediate liquidity and wants higher yields than CDs. You're a yield-seeking fixed income investor looking to allocate a portion of your portfolio with a horizon of up to 10 years to somewhat higher yielding but still stable low-risk assets. Remember, MYGAs tend to pay more than Treasuries currently. Most of our Diamond NestEgg members, Super Savers, and Course fans who've purchased annuities recently are aged 40 plus, and they do fit neatly into one or more of these boxes. Some even fit into all of these boxes. So if this sounds like you, shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist, because there is no cookie cutter, one-size-fits-all annuity solution. Any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. Right. So now that we've covered the top short-term money market rates, the top medium-term CD rates, and the top longer-term MYGA rates, let's move on to the next section of today's video and see how Treasuries fared recently. Which Treasuries rose the most and which ones fell this past week? Here's our usual table with Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Treasury yields were generally down for the week, with the exception of the 1-month and the 3-month, which were up by 2 and 1 basis points respectively. Now, we wouldn't read too much into these small yield upticks for the 1-month and the 3-month, as they're not large enough to say for certain whether these are blip yields, where investors demand a bit of a higher yield to compensate for the uncertainty from the government shutdown, or whether these are just some of the more or less random market movements that we see from time to time. That said, and leaving the 1-month and the 3-month to the side, last week clearly saw a trend towards lower yields for Treasuries, especially those with longer maturities. And this is a complete reversal of what we saw the week before last, when Treasury yields were mostly trending up, as we discussed in our previous weekly update video from September 26th. But back to this week. We know that lower yields mean that people were buying Treasuries. More demand means higher prices, and higher prices mean lower yields. Remember the fundamental rule in the bond universe of prices up, yields down. And if investors were buying more Treasuries last week, this means that they were neither losing trust in Treasuries nor were they expecting higher inflation. Had either of these been top of their mind, they would have sold Treasuries and pushed yields up. But what we saw was the opposite. But why were investors piling into Treasuries? Now, the market doesn't tell you why it's doing something. Market observers have to come up with their own explanations, and these can be quite different depending on their perspectives. There are 2 hypotheses that we've seen frequently in the press and on social media. First, people are just uncomfortable with our ongoing government shutdown. It doesn't look like our 2 parties are getting closer to a resolution anytime soon, and no one knows how long the shutdown will last and how much damage it might do to the economy. If you follow this logic, then what we're seeing is a classic flight to safety, where investors park their money in Treasuries to ride out the storm. But once the storm has passed and the government reopens, the money would flow out again from safe Treasuries into higher yielding alternatives, which means that yields might quickly go up again. And the second possible explanation is that investors turn more pessimistic about the economy. ADP, a leading payroll processing company, reported that private employers shed 32,000 jobs in September. Now, ADP is a private company that only sees its own clients, so we can't really be sure that their calculation is a fair representation of the entire market. But given that we didn't get the official employment report on Friday due to the government shutdown, as I mentioned before, this is the best data we have. And these job losses might indicate a wider slowdown in the economy, or even a recession, which might in turn lead to lower rates across the spectrum. So under this hypothesis, investors are buying treasuries to lock in current still attractive treasury rates because they expect lower rates for longer in the future. Now, let's take a look at treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Decreases in rates are shown in red. So, given the decreases this week, the yields across all maturities are down a bit more versus the beginning of the year, and especially in the middle of the range. That said, yields are still at attractive levels compared to the past 2 decades, as we've discussed in the first section of the video. And because the financial world is never easy, let's have a quick glance at the stock market now. The S&P 500 as a broad-based index for the largest public U.S. companies closed this week at 6,715.79, a new all-time high. So, how do we reconcile this new record high for equities with the more subdued picture from the bond market? Is the equity market right to be bullish, or is the bond market correct in predicting a possible slowdown or even recession? So in the past, it seems that the bond market was right more often than the equity market, which is prone to periodic overshooting. But as I always say, I don't have a crystal ball, so we'll need to see. What do you think? Is the equity market right to remain bullish, or is it just a bubble? Or are you with the bond market and locking in rates now while they're still attractive? Or maybe you diversify if you can't make up your mind. Drop a comment below and let me, Marcus, and the community know. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we know where Treasury yields ended the week, let's move on to the next section of today's video. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. And if we scroll down, we can see that the 3-year T-note, the 10-year T-note, and the 30-year T-bond will also be auctioned off this coming week. The 3-year is not a reopening auction, but the 10-year and the 30-year are, so we already know the coupons on these two. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. Here's the coupon and the expected yield for the 3-year T-note auction. Here's the coupon and the expected yield for the 10-year T-note auction. And here's the coupon and the expected yield for the 30-year T-bond auction. Please keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And as always, if you want to learn more about bond investing and building out a bond portfolio while rates are still attractive, then check out this video here on our bond courses. And if annuities are more your cup of tea, then shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist who can help you create a customized plan that works for you. See you again very soon with more brand new wealth building content for your financial journey.